Hello everyone, I am Michael Ruger. I am the managing partner of Greenbush Financial Group. It's been a super challenging month for the markets in January. The S&P 500 as of January 21st has already sold off 7.7% for the year, which is a sizable decline. And when I actually look back in history over just the last 10 years, there's only been a handful of months where the S&P has dropped by more than 5% in a single month. So we're actually going to go back and look at those market scenarios to try and answer the question, when that's happened in the past, after these big down months, has the market tended to continue its downward spiral, or does it recover in the months to come? The recent sell-off has also been very widespread. It hasn't been limited to just stocks. In January, stocks have sold off, bonds have sold off, crypto has sold off, and cash continues to be eroded by inflation. It's really created this nowhere to hide market environment during these first 3 weeks. And when you look at the major indices, you can see it. So the S&P 500, as I mentioned, is down 7.7% this year. The Nasdaq, which is where most of the tech stocks are down 12%. Small caps down 8.5%. The aggregate bond index is down 1.7%, and Bitcoin is down 24% year to date. I'm going to cover what we believe has caused this January sell-off and whether or not we think it's going to continue. Let's kick this off with our big question, which is how many times in the last 10 years has the S&P 500 dropped by more than 5% in a single month? And the answer is 4 times. If you look at the returns, February 2020, it dropped by 18.9%. November 2018, it dropped by 5.5%. December 2015, 6.4%, and July 2011, 10.4%. Next question. How many times did the S&P 500 post a positive return 3 months following that big 1 month downturn? And the answer is all of them. When you look at the results, from March 2020 to May 2020, it returned 16.7%. December 2018 to February 2019, 9.5%. January 2016 to March 2016, 18.6%. And August 2011 to October 2011, 4%. These big market downturns that come fast and swift cause investors to feel fear, uncertainty, stress, and that emotion tends to cloud their ability to see the bigger economic engine that's at work. All too often I hear from investors, big market downturn, hey Mike, markets dropped by 7%. I think we should go out and sit in cash and wait this thing out till things get better. The difficult thing becomes that when you look at the history of these market corrections, most of those recoveries happen before things feel better. So what you have investors do is they go out, they sit in cash, things get better, market recovers, and they don't get back into the market until the market is already appreciated and they're back in at those higher levels and they've essentially locked in their losses. Much of what's happening right now, we forecasted in our December 2022 market outlook video, which you can find in the description below. Interest rates are moving higher. Fed is on the move. We're going to have more volatility. Tech stocks are going to come under pressure. It's only when things start to happen that are outside of what we expect that then it requires us to go back in and make big changes to client portfolios. But before I get into some of this bigger long-term picture items, let's first look at what prompted this sell-off in January. There are a number of factors that we feel have really contributed to this steep sell-off in January, which include the Omicron cases have surged dramatically. The Fed has taken a more hawkish tone in their January meeting. Interest rates are rising. There's been a sell-off in tech. COVID investment plays are starting to unwind. And then also the unexpected loss of the child tax credit monthly payments to families. Some of this market downturn has been fueled by the larger than expected surge in the Omicron variant of COVID. If you look at the number of confirmed cases in the US, it spikes up over the right-hand side, much larger than any of the variants we've seen before. But this shows the 7-day moving average. And if you look all the way on the right-hand side, it's tough to see, but this blue line dropped significantly within the last week, meaning we're probably at the peak and the economy will begin opening up in February and March. The second factor was the Fed's hawkish tone coming out of their January meeting. Now, they had already telegraphed that they were anticipating making potentially 3 rate hikes in 2022, but based on those January meeting minutes, we might be in store for potentially more rate hikes depending on the trend of inflation. It's the Fed's job to keep inflation under control, and they have to raise rates to fight it. But I remind investors, the last time they started a rate hike cycle was in December of 2016. Between December 2016 and December 2018, they did 8 rate hikes, a quarter point each. But during that 2-year period, the stock market went up a little over 15%. Kind of the conclusion you can draw from this is, even though the Fed is raising rates, does not mean the stock market rally cannot continue. The third factor is how sharply interest rates rose in the first 3 weeks of the year. And when interest rates go up, they typically hurt both stocks and bonds. And when you look at the yield on the 10-year Treasury, as of December 31st of last year, it was at 1.51%. And as of January 18th, it was at 1.86%. While that doesn't look like a lot, that is a big move in terms of interest rates. And when you look at it from a percentage standpoint, that's a move of up 23%. Now, while we expect interest rates to continue to go higher into the year, we don't expect that extreme concentration like we saw in January. The fourth is the big correction we saw in tech in the first 3 weeks of the year. The Nasdaq is down 12% to start the year. And at the risk of sounding like a broken record, this was also something in our Outlook video saying we expected tech to come under pressure this year because interest rates were going to be moving higher. Traditionally, when interest rates move up, stocks that trade at higher valuations, typically like tech stocks, usually will start moving down. We saw the same thing in the 70s from the Nifty 50, and it looks like it's lining up that way this year as well. The other trend that we're seeing in January is this unwinding of the COVID investment play, or what we would also call stay-at-home stocks. Things like streaming services, home exercise equipment, electronic document signing, all these investments that did very, very well over the last 18 months. Now that the US is starting to reach herd immunity, where people have either been vaccinated, had COVID, or both, they're starting to reevaluate where these stocks should be priced. So if you look for the first 3 weeks of 2022, some of these names like Netflix is down 33%, Peloton is down 23%, DocuSign is down 23%. The market's trying to figure out where these stocks should be priced in a post-COVID world. The final factor that could have contributed to some of the sell-off in January is the Build Back Better bill, which they were working on towards the end of last year, which was that additional $1.75 trillion stimulus package. The market actually kind of anticipated that was going to go through, but then it didn't. And part of that package were those enhanced child tax credits where the families were receiving that money each month. And even though it was always meant to be temporary as a stimulus program, people got used to that money coming in. So that could potentially put a damper on consumer spending in Q1 and Q2 of this year. With all of those factors on the table, let's get to the really important question, which is, do we expect this sell-off to continue in coming months? And while no one has a crystal ball, I personally would be very surprised if we don't see some sort of recovery rally within the next few months, mainly because we're getting on the other side of the peak of the Omicron variants. Economy is going to start opening up. There's going to be jobs. People are getting higher wages. The supply chain is going to start healing itself. And people really underestimate the amount of cash that's sitting idle in the economy right now. Over the last 18 months, the government has printed $6.9 trillion. That is a lot of money. Even if you compare it to what happened in the 08-09 housing crisis, 08-09, they printed $700 billion to get out of the housing crisis. They just printed almost $7 trillion over the last 18 months. And a lot of that money has yet to be spent due to all the supply chain constraints. The inflation will continue to be the greatest risk to the economy in 2022. Will the supply chain heal fast enough that will allow prices to start to level out and potentially start to come down as early as next year? If that happens, consumers in the interim have jobs, they have some idle cash, interest rates are still fairly low, so they will be able to pay those higher prices brought by inflation in the interim, and we could have another good growth year out of the markets. But that's not to say we are not going to see more months like we saw in January. When the Fed actually begins to start raising interest rates later this year, you could see the market react to that. Even though it's anticipated, once the rates start moving, you could see corrections in the market. But we feel for investors that patience could be rewarded this year. If you have any questions, please feel free to reach out to me at moneysmartboard.com. Thank you.